Did you know the Federal Reserve just made a decision that could silently drain your wallet? While headlines talk about fighting inflation or stabilizing markets, the hidden reality is that these moves often come at your expense. Behind the complex jargon lies a ripple effect that touches your job, your savings, your home, and even the cost of everyday essentials. The truth is simple but unsettling. When the Fed acts, ordinary people often pay the price. Stay tuned, because what you're about to discover may change how you see the economy forever. Number one, rising borrowing costs. Every time the Federal Reserve raises interest rates, the very first thing people feel is the weight of higher borrowing costs. Mortgages, student loans, auto loans, and even personal loans become more expensive almost overnight. That dream of buying a house suddenly looks like a mountain too steep to climb when mortgage rates jump from 4% to 7%. The monthly payment difference can be hundreds of dollars, money that most working families simply do not have. For students hoping to invest in their education, higher loan rates mean carrying debt for decades longer, stretching financial stress into what should be the best years of their life. Even people with established homes and cars feel the ripple effect if they refinance, because the cost of money itself has risen. This isn't a distant policy decision made in Washington. It is a direct bill arriving in your mailbox. What makes this so damaging is how it restricts opportunity. Young people who might have moved into their first home now have to rent for longer, often in overpriced markets where landlords take advantage of demand. Families that dreamed of upgrading to a bigger space for growing children may instead stay cramped in smaller apartments, waiting for rates to fall. Small purchases like cars also lose their accessibility because monthly financing costs can rise to levels that price people out. The burden is not distributed equally either. Wealthier individuals can often buy with cash or negotiate better terms, while middle-class and working-class families feel the full brunt of rising costs. What is framed as a way to cool inflation ends up cooling down the possibilities of ordinary people striving for stability and growth. Economists argue that rate hikes are temporary tools, but for millions of households, the effects are long-lasting. A person who locks into a mortgage at 7% will carry that cost for 30 years unless they refinance, which itself costs money. A student who takes out loans during high-rate years may pay tens of thousands more across their lifetime than those who borrowed earlier. The story repeats across every sector of borrowing. Higher interest rates don't just slow down the economy, they slow down lives, delaying milestones and creating stress where there should be hope. This is why rising borrowing costs aren't just a technical outcome of Fed policy. They are one of the most immediate ways ordinary people feel the sting of decisions made far above their heads. Number two, credit card debt becomes a trap. When the Federal Reserve hikes rates, one of the first places it shows up is on credit cards. Unlike mortgages or student loans that often have fixed rates, credit cards are tied directly to the Fed's moves, which means balances start racking up interest almost immediately. Imagine carrying $5,000 on a card with a 20% interest rate, only to watch it rise to 25 or even 30%. That increase might sound small, but in practice, it can add hundreds of dollars a year in extra payments. For families already stretched thin, those added costs quickly spiral out of control. Suddenly, buying groceries, paying for gas, or covering an unexpected medical bill becomes more than just a transaction. It becomes another link in a growing chain of debt that is almost impossible to escape. The harsh truth truth is that credit card debt is one of the most punishing forms of borrowing. Interest compounds, meaning you are charged not just on the original balance, but also on the interest that has piled up. When rates rise, the snowball grows faster. People who pay only the minimum each month end up giving away thousands of dollars over the years, with little progress made toward actually paying down the debt. For millions of Americans living paycheck to paycheck, this feels like a financial treadmill. They run hard but stay in the same place. The sense of frustration and hopelessness builds as statements show balances hardly shrinking, even after months of payments. For many, it feels less like borrowing and more like being trapped in quicksand, where every attempt to climb out drags them deeper. What makes this situation worse is how normalized it has become. Credit cards are pitched as tools for convenience or rewards, yet rising rates expose their darker reality. Banks thrive because the Fed's decisions create guaranteed profits for them, while consumers pay the price. A rise in just a few percentage points can shift the entire financial trajectory of a household, forcing people to cut back on essentials or delay savings. Unlike wealthy investors, the average family doesn't have a portfolio that gains when rates change. They have bills, and those bills grow heavier with each Federal Reserve decision. This widening gap between lenders and borrowers is why rising credit card rates aren't just a statistic. They are one of the clearest signs of how economic policies hurt the people who can least afford it. Number 3, small businesses squeezed. When the Federal Reserve raises interest rates, small businesses often feel the pinch before anyone else. Unlike massive corporations with cash reserves or access to favorable credit lines, small businesses rely heavily on loans to cover expenses, expand operations, or simply keep the lights on. Higher borrowing costs mean that an owner who once took out a loan at 4% might now face rates double that amount. For a local restaurant, a repair shop, or a small manufacturing firm, those added costs eat directly into already thin profit margins. This makes every decision, hiring staff, upgrading equipment, even keeping inventory, much riskier. Instead of being able to grow and provide jobs, many small businesses end up scaling back or shutting down altogether. The danger here is not only about the businesses themselves, but also about the communities that depend on them. Small businesses are the backbone of local economies, providing jobs, services, and a sense of identity to neighborhoods across the country. When they struggle, entire communities feel the ripple effect. Workers lose jobs, customers lose valued services, and local governments lose tax revenue. The promise of entrepreneurship becomes dimmer for those who dream of starting their own company because the financial risks become too high. This also creates a cycle where only the largest corporations, which can weather the storm of rising rates, remain standing. Over time, the diversity and vibrancy of local economies fade, replaced by uniform chains that dominate because they can afford to. What makes this especially harmful is how invisible it can appear to those not directly affected. News headlines often focus on Wall Street or large tech companies, but the real pain is felt by the coffee shop that delays hiring a new barista, the construction company that cancels plans for expansion, or the family-owned store that closes its doors after decades of service. These stories don't grab national headlines, but they represent the silent consequences of Fed decisions. Every uptick in interest rates widens the gap between the powerful and the vulnerable, reinforcing a system where opportunity shrinks for the very people most in need of growth. That is why rising borrowing costs for small businesses are more than an economic statistic. They are a direct hit to the heart of local communities everywhere. Number 4, rising credit card debt. One of the most immediate and painful effects of the Federal Reserve's decisions shows up in the wallets of ordinary Americans through credit card debt. Unlike fixed-rate mortgages or certain personal loans, credit card interest rates are directly tied to changes in the Fed's policy. That means when the Fed raises rates, the interest on credit cards climbs almost instantly. For millions of households already struggling with record high balances, this becomes a crushing weight. A balance that once carried a manageable monthly payment suddenly grows into a financial trap where people pay more in interest than they do toward reducing the actual debt. Families trying to cover basic needs with credit cards find themselves stuck, falling further behind each month. This issue is particularly damaging because it preys on the most financially vulnerable. Wealthier households may use credit strategically for rewards or convenience, but lower and middle income families often rely on it for survival, groceries, rent, medical bills, or car repairs. When interest rates climb, those essential purchases transform into long-term obligations with ballooning costs. Instead of offering stability, the financial system punishes people for needing credit in the first place. Over time, this leads to stress, declining mental health, and an overall reduction in quality of life. For many, the dream of paying off debt feels impossible, creating despair and a sense of being permanently trapped in the cycle. The broader economic picture makes this even worse. Rising credit card debt doesn't just hurt individuals, it slows down the entire economy. When households direct more of their income towards servicing debt, they spend less on goods and services that fuel growth. Small businesses see fewer customers, larger companies see reduced demand, and local economies become weaker. This spiral of reduced spending feeds into slower job creation and wage stagnation, magnifying the very problems the Fed claims it is trying to address. At the same time, the banking industry profits enormously from the situation, collecting billions in interest payments while ordinary people drown. This stark imbalance reveals a system designed to prioritize corporate gains over household stability, turning everyday credit card users into unwilling revenue streams for financial institutions. Number 5, housing market struggles. The housing market is one of the clearest examples of how the Federal Reserve's decisions ripple through everyday life, and not in a positive way. When the Fed raises interest rates, mortgage rates climb along with them. For families hoping to buy their first home, this can mean the difference between finally building equity or being forced to continue renting indefinitely. A modest house that seemed affordable last year suddenly comes with monthly payments that are hundreds of dollars higher, pricing millions of people out of ownership. This isn't just about houses becoming more expensive. It's about shutting the door on a crucial path to financial stability that generations of Americans once counted on. Renters don't escape this impact either. As mortgage rates rise, fewer people can buy, which increases demand for rental properties. Landlords, aware of this shift, raise rents to take advantage of the limited housing supply. The result is a double blow. People can't afford to buy homes, and they're also squeezed harder in the rental market. For working class families already spending a large share of their income on housing, this leaves almost nothing for savings, education, or emergencies. What was once a stepping stone to financial security becomes a constant drain, creating a growing class of permanent renters with little chance of moving up. The promise of the American dream erodes as homes transform from places to live into speculative assets controlled by investors. The long-term effects of these trends are devastating. Communities become less stable when families are unable to settle into homes and put down roots. Schools, local businesses, and neighborhoods all suffer when people are forced to move frequently in search of affordable rent. At the same time, corporate real estate investors step in, buying large numbers of homes and renting them back at inflated rates. Instead of creating opportunities for families, the housing market is increasingly controlled by those who treat homes purely as profit machines. By pushing mortgage rates higher, the Fed accelerates this process, ensuring that the housing market works for Wall Street far more than it does for Main Street. For millions of Americans, the dream of homeownership fades further into the distance, replaced by financial instability and insecurity. Number 6, small business pressure. Small businesses are often described as the backbone of the American economy, yet they are among the hardest hit whenever the Federal Reserve decides to raise rates. Unlike large corporations, which can borrow at favorable terms and have reserves of cash, small businesses usually depend on loans and credit lines to cover payroll, buy inventory, or expand operations. When interest rates climb, those loans instantly become more expensive, squeezing their already thin margins. What might have been a manageable monthly loan payment suddenly balloons into a financial burden. For many small business owners, it forces impossible decisions. Delay hiring, cut wages, or in some cases, shut down completely. The ripple effect of this pressure spreads quickly. When small businesses struggle, it affects the workers they employ and the communities they serve. Local restaurants, shops, and service providers are often cornerstones of neighborhoods, not just sources of jobs, but also of community identity. Higher borrowing costs make it difficult for these businesses to survive, let alone thrive. Meanwhile, large corporations, which can weather financial storms more easily, end up taking a greater share of the market. This tilts the playing field even further, rewarding size and scale, while punishing entrepreneurship and innovation. The very businesses that bring diversity and character to the economy are often the first casualties of the Fed's tightening cycle. The long-term consequence is an economy that becomes increasingly consolidated. With fewer small businesses, communities lose not only jobs, but also the competitive balance that keeps prices fair and services personal. The Fed's policies, though aimed at curbing inflation, unintentionally widen the gap between Wall Street and Main Street. Corporate giants, flush with resources, can buy up struggling competitors or expand into areas once served by local businesses, further centralizing economic power. This dynamic undermines the entrepreneurial spirit that has long defined the U.S. economy. By pushing up interest rates without providing safeguards for smaller players, the Federal Reserve fuels a cycle where the rich grow stronger, while small businesses, the lifeblood of communities, struggle to survive under the weight of rising debt. Number 7, housing market strain. Few sectors feel the weight of rising interest rates as sharply as the housing market. When the Fed raises rates, mortgage costs climb, making it harder for families to buy homes. A mortgage that once seemed affordable can quickly become out of reach as monthly payments rise by hundreds of dollars. This not only prices out new buyers, but also discourages homeowners from selling, since they would have to replace their low-rate mortgage with a much higher one. The result is a market that slows dramatically, with fewer transactions, less construction, and reduced opportunities for people hoping to step onto the property ladder. For younger generations already struggling with stagnant wages and student debt, the dream of owning a home feels even further away. The strain isn't limited to buyers and sellers. It spreads through the entire housing ecosystem. Builders hesitate to start new projects when demand falls, fearing that homes will sit unsold. Real estate agents, lenders, and contractors all feel the pinch as activity dries up. Even rental markets can be distorted, with fewer people able to afford mortgages. Demand for rentals increases, driving rents higher and squeezing families already stretched by rising costs of food and energy. This dynamic creates a vicious cycle. Higher rates mean fewer homeowners, more renters, and ultimately less stability in housing. For millions of Americans, a house is not only shelter, but also their largest source of wealth. When that market is locked down by soaring rates, it deepens feelings of insecurity and inequality. The broader economy feels the drag as well. Housing is a key driver of consumer spending. When people buy homes, they also spend on furniture, appliances, and renovations. With sales slowing, those industries shrink too, amplifying the impact. Wealth inequality grows as homeowners who locked in low rates see their property values hold steady, while aspiring buyers are pushed further to the margins. The Fed may see higher rates as a way to cool inflation, but for average families, the price is painfully clear. Dreams deferred, opportunities lost, and communities burdened by stagnant growth. In many ways, the housing market becomes a mirror of the wider economy, where stability for the few comes at the cost of growing struggles for the many. Number 8, rising credit card debt. One of the most immediate ways higher interest rates hit ordinary Americans is through credit card debt. Unlike mortgages or student loans, which may have fixed rates, credit cards typically carry variable rates that rise almost instantly when the Fed makes a move. Millions of Americans rely on credit cards to bridge the gap between stagnant wages and rising costs of living, using them for groceries, gas, or emergency expenses. When rates increase, the cost of carrying a balance skyrockets. A family that owes a few $1,000s can suddenly see their interest payments balloon, making it even harder to dig out of debt. This creates a cycle where people pay more in interest than they do toward reducing their principal, trapping them in financial quicksand. The consequences ripple across households. Higher credit card interest doesn't just mean more debt, it also reduces spending power. Every extra dollar spent on interest is a dollar that cannot be spent on essentials like food, childcare, or healthcare. For families already living paycheck to paycheck, even small hikes in interest rates can mean the difference between making ends meet and falling behind. Over time, late fees, compounding interest, and penalties pile up, pushing many into collections or bankruptcy. The stress of this financial burden weighs heavily on mental health, relationships, and overall quality of life. What looks like a simple policy adjustment from the Federal Reserve translates into sleepless nights and mounting anxiety for millions of families across the country. On a broader scale, Rising credit card debt also threatens economic stability. When consumers are crushed under the weight of debt, their ability to contribute to economic growth diminishes. Consumption slows, businesses lose revenue, and the cycle of hardship deepens. Meanwhile, banks profit from the higher interest rates, reinforcing a system where financial institutions grow stronger, while ordinary people fall behind. Instead of reducing inflation, the Fed's decisions often end up transferring wealth from the working class to lenders. In this way, rising credit card rates become not just a personal burden but a structural problem, widening the gap between those who profit from the financial system and those trapped within it. Number 9, weakening job market. When the Fed raises interest rates, it isn't just about numbers on a chart. It directly affects jobs. Higher rates make borrowing more expensive for businesses, discouraging them from taking out loans to expand, upgrade equipment, or hire new workers. Companies begin to slow down hiring, cut back on training, or delay raises, creating uncertainty for employees. Over time, this can lead to outright layoffs, as businesses look for ways to reduce costs in the face of shrinking demand. For workers, this means fewer opportunities and more competition for the jobs that remain, a scenario that puts downward pressure on wages. What looks like a policy aimed at cooling inflation often feels like a tightening noose for the labor force. The effects are uneven but widespread. Industries that depend heavily on credit, like construction, real estate, and manufacturing, are often hit first. Builders halt new projects, factories scale back production, and small companies stop expanding. These shifts ripple outward into related sectors, from suppliers and contractors to restaurants and retail stores that serve those workers. When jobs dry up in one sector, it creates a domino effect, reducing consumer confidence and spending across the economy. Families hesitate to make big purchases. Local businesses lose customers, and entire communities feel the impact. Job insecurity spreads like a shadow, leaving workers worried about whether their paycheck will be there tomorrow. The longer this persists, the deeper the scars become. Workers who lose jobs often face long gaps in employment, during which their skills atrophy or become outdated. Young graduates entering the job market encounter fewer openings, making it harder to start careers or pay off debt. Meanwhile, corporate profits remain insulated, as large firms weather the storm better than small competitors. This imbalance widens inequality, leaving average workers vulnerable while shareholders remain protected. A weakening job market doesn't just hurt individual families, it undermines the strength of the entire economy. By prioritizing financial tightening over employment stability, the Fed risks pushing workers into insecurity, hollowing out the middle class, and deepening the sense that the system is stacked against ordinary people. Number 10, growing wealth inequality. One of the most damaging consequences of the Fed's decisions is how they amplify wealth inequality. When interest rates rise, ordinary people are forced to pay more for credit cards, mortgages, and loans, while the wealthy often benefit. Those with large investments in bonds or savings accounts see higher returns, while homeowners with low fixed-rate mortgages remain protected from the pain. For working families, however, the story is very different. They face higher borrowing costs, stagnant wages, and greater financial stress. The gap between those who gain from the Fed's moves and those who suffer grows wider with every rate hike. turning an already unequal system into an even sharper divide. This disparity shows up not only in finances, but also in opportunities. Wealthier households can afford to keep investing, buying homes, and sending children to top schools, even during economic downturns. Struggling families, meanwhile, are forced to cut back, abandon dreams of homeownership, and take on more debt just to stay afloat. As small businesses close and middle-class families tighten their belts, corporate giants and investors swoop in to consolidate more power and wealth. Over time, this creates a cycle where the rich use their advantages to keep climbing higher, while the rest of society fights to hold its ground. The Fed's policies, though often presented as neutral or technical, end up reinforcing structural inequalities baked into the economy. The social consequences are profound. As inequality widens, frustration grows. Communities see fewer pathways to upward mobility, and political divisions deepen as people search for someone to blame. History shows that societies with extreme inequality face greater instability, distrust in institutions, and weakened democratic structures. By fueling these divides, the Fed's decisions contribute to a sense of disillusionment, where many feel the system is rigged against them. Instead of promoting stability, rising rates exacerbate the cracks in society, leaving millions struggling while a small elite grows richer. The long-term danger isn't just economic, it's social cohesion itself, as inequality threatens to pull the fabric of the country apart. The Federal Reserve presents its decisions as carefully calculated moves to stabilize the economy. But the reality on the ground tells a very different story. Each rate hike ripples through households, businesses, and communities, leaving ordinary Americans carrying the heaviest burden. From rising mortgage costs to crushing credit card debt, from small business closures to growing inequality, the Fed's policies consistently shift pressure away from the financial elite and onto working families. What looks like a technical adjustment in Washington translates into higher bills, fewer opportunities, and greater insecurity for millions of people. Yet within this challenge lies a critical opportunity: awareness. By understanding the real effects of these decisions, we can begin to question the narratives we've been fed and demand accountability from institutions that shape our lives so profoundly. Economic policy doesn't have to be a mystery reserved for experts. It's about jobs, homes, healthcare, and the stability of our future. If we ignore the signs, inequality will deepen and the path forward will only become harder. But if we confront these truths, we can spark conversations that lead to fairer, more balanced solutions. So as you reflect on these 10 reasons the Fed's decisions hurt you, remember this: the most powerful tool you have is knowledge. The system thrives when people remain unaware. It begins to change when people start paying attention.